Jeff, when you look at global trade and you think about what it means for your world, do you assume they can narrow the trade deficit? And what does that mean to global trade full stop?
Well, I think the only way they could narrow the trade deficit from a oil perspective is to do something like a border tax adjustment. We don't see that as being a high probability event. But in terms of looking at the commodity market going forward, the one thing that's likely to happen with these OPEC production cuts, you're likely to see a drop in crude oil imports substantially. And that's likely to be reflected in lower inventories, and that's really the core behind our bullish view on oil.
Is that the conversation down in D.C. at the moment, David? The 2 points that Jeff just made. One, we'll be importing less crude here into the United States. And two, the border adjustment tax, that it just won't happen?
Well, I must say that importing less crude does not help President Trump and the people who elected him. They want more jobs. You know, it doesn't help them to report less crude. But it seems to me, Jeff, that really one of the dilemmas they have is the more they have pro-growth policies, the more it may strengthen the dollar, which actually ironically drives up the trade deficit.
Well, I think when you bring it back to the commodity space, the one thing that we have seen since about October last year is really a disconnect between oil, commodities, and the dollar. So that natural shock absorber that the system has had, I'd say, over the last 15 years is likely gone. And we think we're in a new regime where that correlation is unlikely to return to the same levels that we saw over the previous 15 years.
Well, let's get to that in just a moment. I want to talk about the strong dollar and the Federal Reserve with you, Steve Ricchiuto. Steve, here's a headline for you. Steve Ricchiuto does not think the Fed will hike in March this year. Why not?
Well, I mean, it's been my call all along, May, when we put out our year-ahead forecast back in November, because we have to do it early for internal compliance purposes. You know, I put the move in May, and the reason why I put the move in May is because we get the budget in April. The Fed would have the opportunity to assess the data. We knew Q4 and Q1 were going to be on the weaker side, and they are. So it made sense to wait until you saw the budget numbers to then go forward. And I still think that's the driving issue right now. I think the Fed moving in March will be a premature move. I think it's very comparable to what they did in December 2015, and it didn't end so well for them in January 2016, and it put off further tightening until December of last year. And I think they run the risk of making exactly the same mistake this time.
Well, I want to pin you down just a little bit. Is it a case that Steve Ricchiuto thinks they should not hike, or you do not think they will hike?
I think when they sit down and they discuss it and they look at what they've done and they look at where the data is, and they're going to have another payroll employment number, they're going to have a few more pieces of important information on what's going to happen with industrial production, what's going to happen with capacity utilization, I think they'll opt to say, look, we're not moving in the month of March. We're going to have a press conference after the May meeting, and then they'll move in May. That is my call.
Well, the conversation I had last week with someone was that you have to calibrate your investments towards where you think we are in the business cycle, Jeff. Where do you think we are in the business cycle, one? And can the politicians in D.C. extend it, two?
Well, let's think about the business cycle as being in 3 or 4 different phases. Phase 1 is below capacity and shrinking, like 08-09.
Yeah.
Phase 2 is below capacity and growing. That's June 09 to, I'd argue, where we are right now today. You look at the data in both the U.S. and China, the output gap is roughly 0, which means we're at capacity moving into phase 3 of the business cycle, which is above capacity and growing. What does that mean to investments? Typically, commodities and real assets outperform financial assets in phase 3 of the business cycle. Why is that? Because financial assets are what we call anticipatory assets. They anticipate when you hit capacity. Real assets like commodities are spot assets. They perform well when you're actually in that above capacity and growing environment. You know, historically, when you look, going back to 1970, the ratio between commodities and financial assets, whether it's equities or bonds, every single time in the second half of the business cycle, you get outperformance of commodities. One last point. How do all those business cycles end? You run out of commodities.